Our guest in this segment is Financial Phil McCoy from Ameriprise Financial and the Mirius Group of Financial Advisors on Winchester Avenue, Martinsburg. Good morning, Philly.
Good morning, guys. How are you all?
We are better than the Steelers, Phil. How about yourself?
Well, so is everyone. You know, I came to the conclusion last night, watching that game, every second of it, mind you, that maybe I could make a comeback and play tight end or wide receiver for whoever the Steelers may be playing next week.
Yeah, our defensive geniuses who run things don't know how to cover a tight end. And this goes on every year, by the way. He's the big guy at the end of the line of scrimmage. Sometimes he's in the slot. Just figure it out. He's the biggest guy out there catching a pass. Should be easy to find.
Yeah, but it was wide receiver appreciation day or something, or tight end appreciation day or something like that yesterday. Pittsburgh participated fully in that event.
God, you guys are so fickle. Last week, the week before, you're high as a kite. Man, you're going to take on the world. Now it's just like, oh, my team sucks. They're awful. They need,
Thus is sports ball, John. 1 week they're on top of the world, and the next week they're awful. But they don't pay our bills, and they don't control the stock market, so I'm still living the dream.
So we were just having a discussion during the commercial break. Elon Musk, I guess, is looking for $1 trillion, not billion, but $1 trillion financial package from Tesla. And Tesla has to decide whether or not they're going to approve it and or not, which would risk losing Elon Musk, of course. Now, Phil, $1 trillion for an individual is an amount to this point nobody has yet amassed. We're going to have somebody, obviously, somewhere in the future, and probably not that far away, who will have it. But let's put it on an amount of money that you hear about more often now, which is $1 billion. Now, realistically, for a person who has $1 billion, unless you're planning on trying to buy a sports franchise, it would be remarkably difficult to spend $1 billion, right?
I would imagine. Have you ever seen the movie Brewster's Millions? You ever seen that movie with Richard Pryor back in the 80s?
I did.
That would maybe they should remake that. But that was a really good movie. But and maybe they should try to remake it.
Well, the premise of that was
package.
Yeah, the premise of that was, just so everybody knows, is Richard Pryor was going to inherit an incredible amount of money, and so he had to spend a certain amount in a certain amount of days as a way of making him get sick of spending money, so that when he inherited money, he'd be more careful with it.
Yes, and I think it was 30 million in 30 days. Does that sound right?
Right.
But it was,
and he couldn't just go hire someone and pay him $30 million. There was only so much he could spend on certain things. Yeah.
Yes, but there was a point to that movie, and I think I think all advisors should watch that movie, honestly. But there was a point to it, and he did get sick of spending that money. And I think and if memory serves me, he came to the conclusion that he didn't want it. He was fine without getting the inheritance. He didn't want that type of money. He just wanted to be himself as he was before the inheritance.
Yeah. Well, if that's going to be paid out in the standard work year, that's $480,769,231 an hour.
It's a lot.
He can come see me for one of those hours. I'll help him out.
Yeah. Phil, we got a lot of things happening this week. We've got financial reports coming in. When does the Fed meet for another rate cut? I understand that's imminent as well.
That's coming this week. I think it's Wednesday. Don't hold me to that. I didn't exactly find it. There's a lot in the headlines this morning. So we know that the Federal Reserve is going to meet this morning. We're assuming that they're going to cut rates by 0.25%. That's an assumption. And, looking forward to that, to his speech, which I think is Wednesday. And if I'm wrong, listeners, don't hold it against me. But I think it's going to be the verbiage after the rate cut that will move our markets the most. By and large, we are assuming, especially after the CPI report that came 9 days late. The CPI report came out yesterday. That is the full assumption. But on top of that, we also have 5 of the Mag 7 that's going to report earnings this week. So the artificial intelligence / technology companies that has driven our markets to these all-time highs, which I think we hit again last week, is going to be tested by earnings and forward-looking guidance. And again, the forward-looking guidance may be the more important part of that. And then, of course, what I'd like to talk about the least is that there's a framework with the deal with China, and I thought that was already done. But we had some volatility last week because something was falling apart, I guess, with our previous deal with China. I'm not quite sure. but apparently there's a framework for yet another deal with China. So there's a lot of good momentum going into Monday morning, but there's also some potential headwinds by way of what does the Federal Reserve have to say about rates moving forward, and, of course, earnings and what those companies have to say about their potential profits moving forward.
Billy.
Yeah, Phil, this discussion with China, we'll find out a lot more in the weeks ahead, and I'll probably the results several years down the line. But one of the questions been raised now is to get access to the rare earth metals, which China has a virtual monopoly on. We're prepared to give some inroads, some availability of our chip industry. So the question is, are we trading too much at this time to get access to the rare earth? Your thoughts?
I don't know, to be quite honest with you, because on one hand, if we don't and we don't have access to that, then that's an issue. But on the other hand, if we do, then we're giving them too much information, and there's always been the concern that China has too much of our intellect, if you will, or intellectual property. And so I think there's a risk either way. But what is clear is that we, as much as we like to say that we want to be independent, we want to rely only upon ourselves, that we are not in a position to do that economically anyway. We're not in a position to do that as it pertains to China.
How do we get ourselves in such trouble with the rare earths? It's not new. It's not just happened overnight.
No, that's been something in my working life, especially in this industry. We have always been reliant upon others for that rare earth. So I don't know when it happened, don't know how it happened, but of course it happened slowly. But we definitely are relying upon China for that.
Mr. Gilstrap.
As far as the trade deal with China, let's assume that everything turns out well. We make nice, and we drop the tariffs, and everything is happy. How do the tariffs work? Does it affect the cargo that is in the hold of ships on the way to or from China? Does that suddenly become less expensive, or is those tariffs already been paid?
My understanding is that they're paid at the ports.
Which
That's
one?
My understanding, and again, I could be wrong. Our port. So
Okay.
when they get here, that is my understanding. However, I don't know that if there's a price that's associated with those coming overseas. If you think of gas already in the ground, as I actually sit here at a gas station, as I normally do on Monday mornings, if you think of gas that's already in the ground, that price of that doesn't change just because we haven't put it into our vehicles yet. So if there's an assumed tariff on those goods and services coming that's on a boat somewhere, then I think we will see that price when it gets here, whether or not a dealer is made while it's in transit or not. I hope that makes sense. But if it was assumed that if I purchase that, assuming that I'm going to have to pay that tariff when it hits the port, then that's going to still make its way to our shelves or whatever we're purchasing. That won't change what's in transit already, because if any deal is made while things are in transit. But these tariffs it's almost become white noise over the last 6, 7, 8 months. It's almost become white noise, with the exception, because we haven't even brought up that we added 10% onto Canada apparently, but with the exception of China, most other tariffs have become white noise to our markets anyway. They've become white noise, and we start to look at what proof is in the pudding by way of inflation and how much of that inflation is credited to said tariffs.
Well, there was a piece, I don't know if it was, I think it was on Sunday morning, CBS Sunday Morning. The CEO of Ford was talking about how the component parts of cars are getting more and more expensive because of the tariffs, and then and the competition from Chinese cars, their electric cars in particular, driving essentially our auto industry is in great jeopardy, in part because of the tariffs. Things are getting more and more expensive. Are we seeing any of that showing up in the markets? The fear.
Yes, and it's debatable whether or not it's from tariffs or from other sources. But there's a lot of debate out there. Is this because of tariffs? But we are seeing it, and the debate comes from the standpoint of, can companies absorb the price of tariffs, or are they going to pass those on? And we've maintained for quite some time that even those that may not be subject to tariffs, if you're making, and I've used avocado, I don't know if it's a good example, but I've used avocados as an example. But if I'm used to purchasing my avocados from Mexico, but now there's a tariff, and that avocado becomes $1 per avocado to $1.75. Well, all along the avocados in California were $1.25, $1.25. They're not going to remain at $1.25 if the competition is $1.75. So even those that aren't subject to tariffs could see price increases just because there's capacity for that via competition. Does that make sense? So that's where the whole idea of these tariffs will cause grandstanding inflation across the board, whether or not a company is subject to them or not. It's debatable. And will a company do that? I assume that they will. I assume if I'm selling something and my competition is twice the price, I'm not going to remain at that, because I now have the capacity to increase those prices. Even if it's just a little bit, I have the capacity to increase those prices. And we all know, regardless of the company and our like or dislike for them, at the end of the day, they're there for profit. And that if that will increase their profit, they will do so. And if they do that, that then furthers along the CPI. And then to go further into this whole equation, what is the consumer capacity for those price increases? Will we continue to purchase those? Will we continue to purchase electric cars? Will we just buy lesser of a car? Or will we keep fixing the current cars that we have, which I think is what we're seeing right now? People are hanging on to what they currently have for a few reasons. As far as the auto market is concerned, one, rates are high, and it's more difficult to buy an affordable vehicle because rates are still at an increased level. But two, because the prices of cars have crept up a little bit.
Financial Phil McCoy, our guest here on the program. There's an article on the CNBC.com website by Jill Schneider today that says VOO and chill, why this popular investment strategy may be losing its appeal even with stocks at all-time highs. I'm going to read you a little bit of the article, Phil, just to get your take on it. Passive investing through exchange-traded funds, ETFs, may be losing its appeal. Title Financial Group Chief Revenue Officer Gavin Fillmore finds many of his clients are no longer satisfied with buying popular ETFs tied to market indices. I think investors are looking beyond just the, let's call it the VOO and chill approach, where you just buy the index in an ETF, which is a great approach, but they're looking for diversification. And they're not finding it within the product or within the index, so they have to look beyond that. Fillmore refers to the Vanguard S&P 500's ETF VOO, which tracks the S&P 500's performance. Both are up almost 16% this year. Meanwhile, Strategic Securities' Todd Sohn contends its investors are losing diversification by using the S&P 500 as a benchmark. Imbalance is the perfect word, said the firm's senior ETF and technical strategist in the same interview. He added, technology now accounts for more than 35% of the S&P 500 index, a record high. Meanwhile, defensive sectors, including consumer staples, healthcare, energy, and utilities, are all at an all-time low weight of just 19% of the S&P 500. So where are traders turning? Sohn is seeing renewed interest in small-cap stocks. The Russell 2000, which tracks the index, which tracks the group, hit an all-time high on Wednesday and just saw its best week since August. It's now up more than 28% over the past 6 months, outperforming the S&P 500. Early this month, the Russell 2000 topped 2,500 for the first time ever. Phil, you've long talked about the Russell 2000. It's been down for a while, but this year it is roaring back. What do you think of what I just read to you regarding what these folks are saying investors are now doing?
So what they're talking about is simply, and Dave Ramsey kind of pushes this idea, and it's better than nothing, I will say that, but if you just bought an index and move along with that you will see returns over time. So if you took the VOO or QQQ or IYY, which tracks the Dow, what the perception is that you're going to see decent returns over time. It goes on further to suggest, but you're losing diversification. Doing so, and you are. You're losing diversification because of technology becoming a bigger piece of that pie. So if you look at the S&P, and its largest piece is now technology, upwards of over a third of the entire index. So therefore, in order to be completely diversified, and this is what we've always done, in order to be completely diversified, you wouldn't just have a single index. You would dig into that and say, okay, let's look at each and every asset class, whether you're breaking those down with large cap being large companies, value and growth, value being something like Procter & Gamble, growth being something like Apple or even Tesla, or the NASDAQ would be a growth. And mid-size, small-sized companies, all in value and growth, or if you're going sector-specific. But you do need to have diversification. Those that are completely diversified right now, probably they may not be as happy because they're looking at, I'm completely diversified, so therefore I don't have a third of my entire portfolio all wrapped up in the Mag 7. I don't have that. So therefore I'm trailing a little bit, and I'm not happy with what my advisor is doing. They will be happy, however, when that we always talk about this bubble bursting. We don't fear a bubble bursting in our practice. We're not afraid of the tech sector bursting. The reason we're not afraid is because we don't have all of our eggs in that basket. Make no mistake, that basket's fairly large, but all of our eggs aren't in that basket. So when that bubble bursts, our clients aren't going to see that same fall that sector-specific client may encounter. However, the grass is always greener on the other side, right? So if I'm completely diversified and I'm looking at what QQQ or the NASDAQ or even the S&P has done as a whole, I may not be completely satisfied because why aren't I keeping up with the overall market? Well, the reason you're not is because there's more in those value companies. There had been more in those small cap companies that are doing really well now, but it took them a while to recover. That Russell took quite some time to begin recovery, and we knew that was going to come. You knew it was going to come when rates started to decrease, and we were in that rate cutting environment, and that's why you've seen that Russell small cap do well now. But you didn't know when that was going to come, so therefore, because you didn't know exactly when, you had to have exposure to it. So it took quite some time for that to catch up. But to stay completely diversified is going to even out your returns. So when things are bad, they're not going to be as bad. When things are really good, they may not be as good, but in the long run, you're going to when you look up and see, hey, my returns have met what the indexes have done. I just didn't experience the same volatility that the indexes did.
So what do you think about jumping in the way you invest based on what interest rates are doing, Phil, from index to index?
Don't like it at all, and don't like it at all because we're almost that's just a smaller form of timing the market, and that's something that we should all avoid, because if you did, all of the experts, most of the experts would be wrong half of the time. So to stay diversified, and I'm not saying, you may find yourself if you land on a pile of cash, for instance. I'm not saying if you land on cash and the markets are all-time high, you should just throw it all in. You may want to step back and do it a little bit slowly. If the markets are down, go ahead and throw it all in. But that diversification that suits you, that suits the individual investor, whether stocks, bonds, cash, the whole 9 yards, that should still be applied no matter what the markets are doing. Where I would agree, and probably brought this up way too late, that timing could be wise is during Roth conversions. If you're one that is looking to do a Roth conversion, or you do them each and every year, you probably should sit back and say, let's do those during periods of when our markets have fallen, and then convert that money then. So I'm paying taxes on less. I'll get it over to the Roth side, let that grow tax free, and I'll make that move when markets are down. So that is a form of, I guess I speak with forked tongue sometimes, that is a form of market timing, but you should still, regardless, keep your diversification based off of what your wants, wishes, needs, and goals are and where you are in life.
Bill, we have 1 minute left. Make it a quick one.
Will be a quick one. Jerome Powell's term's up, I think, in the next May. Supposedly by the end of the year, his successor will be identified. There's 5 or 6 names floating around. Does the market have a choice between these names, Phil, or is it more or less benign to the who's going to be headed?
The Fed.
The market for short-term prosperity, the market wants whoever's going to cut those rates. And if that means it's a negative thing 10 years from now, it doesn't really care. The markets want those rates cut, and that's some of what's underpinning some of our markets today. Is even if they're not cut, it is assumed they're going to be cut in May when that replacement is made.
How do we reach you for more information today, Phil?
Unless you're going to tease me about Pittsburgh, you can reach us at 304-263-4343 or stop by and see us with an appointment at 1270 Winchester Avenue, right here in Martinsburg.
Thank you, Phil. Have a great day.
Thank you, guys. Appreciate it.